Hey option traders, for today's trade we're looking at an option strategy known as a broken wing butterfly in the VIX, also known as the CBOE Volatility Index. The VIX is not a stock but a real-time index that represents the market's expectations for near-term price changes of the S&P 500. You can find the VIX ETF on MarketSmith using the symbol 0VIX. The most important thing to remember is that the VIX represents the market's expectations for volatility over the coming 30 days. Volatility is a measure of how fast prices change, which is why investors use the VIX to measure the level of risk, fear, or stress in the market when making investment decisions. A spike in the VIX represents an influx of fear in the market and vice versa. Following the March banking crisis, the VIX index has dropped considerably, falling from 31 down to 19. So today we're looking at a strategy that will profit if the VIX finishes between 17 and 19 on May 16th. The strategy is called a broken wing butterfly. A broken wing butterfly with put options is created when an investor sells two puts at a given strike price, then buys one lower strike put and one higher strike put relative to the two short puts. The lower strike put is going to be further away from the short puts than the higher strike put. Each put in this setup will use the same underlying security, the same expiration date, and different strike prices except for the two short puts, which will have the same strike. A broken wing butterfly with put options is designed to benefit from decreases in underlying volatility. The trade will make a profit even if the underlying price goes down, as long as it does not exceed the credit spread strikes. If it does, then the trade will start to lose money. On the upside, the trade has zero risk. You'll earn the biggest profit if the stock moves slightly lower toward the short put strikes. If the stock moves below the credit spread strikes, then you'll end up with a loss. But the good news is, with your risk being defined, you know your worst case scenario in advance before you enter the trade. So now with all of that said, let's take a look at my trading platform and set up a real trade using the VIX. Using the May 16th expiration, we're looking to buy one put with a 16 strike, sell two puts with an 18 strike, and buy one put with a 19 strike. Notice that the upper strike put is 1 point away from the middle put, and the lower put is 2 points away. This broken wing butterfly trade can be placed for a small debit of around $5. This debit is the most the trade can lose above a VIX of 19. The worst that can happen is all the puts expire worthless, leaving the trader with just a small loss. On the downside, the maximum loss can be calculated by taking the width between the middle and upper strikes multiplied by 100 plus the premium paid. That gives us 1 times 100 plus 5, or $105. The maximum loss would occur if the VIX finishes at or below 16. But that's something that hasn't occurred since 2021. The maximum gain can be calculated as 1 times 100 minus 5, or $95. The ideal scenario for the trade is that the VIX closes right at 18 on May 16th. As always, remember that if you're new to options, make sure you practice with a virtual account before risking any real money. And remember that options are complex and investors can lose 100% or more of their investment. Be sure to check out the new Options Trader app from IBD for more digestible options education and tons of great trade ideas. And be sure to join us here for our regular options content where we break down a new trade idea every day.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.